Hello and welcome to the Web3 Guides YouTube channel. My name is Andrew and today we are going to talk about the new DCA trading bot for Binance Futures. We'll explain how it works, compare it to other similar trading bots, show you how to set it up from start to finish, and also give you some recommendations on how and when to use it and how to avoid unnecessary risks. So don't forget to subscribe, hit the bell button, and let's get started. So, dollar cost averaging, or DCA, is an investment strategy in which you buy an asset at a regular interval. The goal here is to reduce the average cost of your investment and lower the impact of volatility. In its traditional sense, DCA is mostly used for long-term investment, and the most common recommendation is to buy equal portions of an asset following a set schedule, for example, each week or each month. But slightly different forms of DCA are also used for medium-term and short-term trading. The DCA trading bot also uses a form of this strategy. The bot enters the market, and when the price drops below its entry, it starts gradually placing buy orders, following a preset price change interval, to eventually get a more favorable average entry price. And when the price bounces back up, the bot takes profit at a predetermined level. For a long time, this bot was only available on Binance for spot trading, but recently they announced the new Futures DCA bot. By the way, if you don't already have an account on Binance, you can use the link in the pinned comment under this video and get 20% off trading fees, as well as a welcome bonus. If you sign up on mobile, use our code BONUSOK instead. So, there are a few differences between spot and futures DCA bots. First of all, futures DCA can enter both long and short trades. The spot version, on the other hand, is purely long biased, but you can run it in two different modes. In the buy mode, it uses the basic algorithm we described already, but if you already have some amount of the underlying asset, you can run it in the sell mode, in which it will gradually sell the asset, and then when the market pulls back, buy it again. The second difference is of course that you can use leverage with the futures DCA bot. Also, because on futures your positions can get liquidated and leverage can increase your losses if it's not used properly, the futures DCA bot can be more risky than the spot version. At the first glance, the futures DCA bot is also similar to the futures GRID bot, but there are several key differences between them. First of all, each order that the GRID bot places opens a separate position, and those positions are then closed independently of each other. So the GRID bot makes a lot of smaller trades and accumulates the profit. The DCA bot, on the other hand, increases the size of a single position to get a favorable average entry price and closes the entire position when it takes profit. Secondly, the GRID bot works in a predetermined price range set up by the user. When the price leaves the range, the bot temporarily stops working. For it to follow the market, you will need to turn on the trailing mode, but on Binance, trailing only works in one direction, either up or down. The DCA bot follows the market by default. After it takes profit and finishes one round, it opens a new trade at the same level it took profit and starts a new round. Thirdly, the GRID bot is a bit trickier to set up, while the basic futures DCA bot is a bit more intuitive to set up. Finally, the DCA bot is a bit more risky, but the difference is not that dramatic, and you'd have to manage risks and use stop loss for both anyway, especially on futures. Now let's see how to set up a futures DCA bot. First, you'll need to go to the trading bot section and choose the futures DCA. Here you can also find the links to Binance's guides on how to use it. Alternatively, trading bots can be accessed directly from the futures trading terminal. Now let's go over the main settings. First of all, you'll need to choose the direction in which your bot will trade. After that, you set up the price deviation. It is the price percentage change between the bot's orders. It works like this. The first order with which bot enters the market is called the base order. All the subsequent orders are called the DCA orders. If you set up the price deviation at 1%, for example, when the price drops 1% below the base order price, the bot will place the first DCA order. And if you use basic settings only, the same interval will be used for the subsequent DCA orders. Then we set up the take profit level. It is set up as a target profit percentage based on the average price your bot manages to get in a given round. So, if you set up your take profit target at 2%, for example, the bot will close the round when the profit reaches 2% of the average entry price. In the next section, we set up the investment parameters. Here we need to enter the amount of margin for the base order and the subsequent DCA orders. It is basically the amount of actual money you invest, to which the chosen leverage will be later applied. You can set up the desired leverage in this section as well. Lastly, here you will need to set the maximum amount of DCA orders. After that, below you will see the total amount of actual investment and the estimated liquidation price. There is also an option to automatically add margin if the bot gets close to the liquidation price to avoid being liquidated. With this option enabled, the bot will be able to use money from your account when it is necessary. Note that this further increases the risk and potential losses, so consider it before turning this option on. Now let's get to the advanced settings. First, here we can choose the start condition for our bot. With the default setting, the bot will place the base order immediately after it's launched, but you can also set a specific trigger price at which the bot will enter the market. Then you can set the price deviation multiplier to adjust the gap between DCA orders. If the multiplier is lower than 1, the gap between orders will gradually get smaller. If it is higher than 1, the gap will get bigger. Note that there is a specific formula that is used to determine the price deviation change. You can see it on the screen now. So with this formula, if we set the deviation multiplier at 2 with the base deviation of 1%, it will look like this. The first DCA order will be placed at 1% price deviation, the second at 3% and the third at 7%. You can also set the multiplier for the size of the DCA orders, which makes each subsequent DCA order larger or smaller than the previous one. The size multiplier uses a more simple formula. So if we set it at 0.5, for example, each subsequent DCA order will be 50% smaller than the previous one. And if we set the multiplier at 2, each subsequent DCA order will be twice as big as the previous one. You get the idea. Then we can set up the stop condition for our bot. If it's not set, the bot after finishing one round will immediately start the next one, close to the previous exit price. Alternatively, you can choose one of the two stop conditions. The bot will either stop after the current round or when a specific trigger price is reached. Finally, we can set up a stop loss for our bot as a percentage target. The stop loss is calculated based on the entry price of each individual round. So if we set it at 10% for the long DCA bot, it will close the position if the price drops 10% below the entry price of a given round. Before you start the bot, you can also click the preview button and see the levels at which the bot will place DCA orders, the estimated average price and the take profit price. Finally, some tips and recommendations for using the Futures DCA bot. First of all, you don't want to use the bot in a very strong trend without meaningful pullbacks. The bot needs pullbacks to execute at least the majority of the planned DCA orders and get a good average entry price. Plus, usually after a big strong move in one direction, there is an equally strong major pullback and potentially even trend reversal. So choose more stable and predictable market conditions and stick to less volatile markets with high liquidity. Choose the assets with high market cap, where there are less random price fluctuations. Secondly, don't just run the bot blindly. Analyze the chart and figure out how the asset currently behaves and what are the average moves you can expect from it. That will help you choose the right settings. For example, the price deviation parameter should be a bit higher for higher volatility and vice versa. And your take profit target usually should not be very high, especially if you plan to run the bot for several consecutive rounds. Usually with the right settings, it can close a round not very far from the base order price and still make reasonable profits overall. And most importantly, don't forget about risk management, especially on futures. Don't use high leverage, at least until you get familiar with the bot and develop a working strategy. When testing for the first time, keep leverage as low as possible. Set for yourself a reasonable risk per trade limit. The general recommendation is no more than 1 to 3% of your total capital per single trade. Secondly, determine the logical stop loss level for your bot based on your analysis. And finally, calculate the appropriate total investment amount based on your risk parameters. If you're a new trader, you should first get familiar with the basic principles of risk management. It is one of the most important things for long-term success in crypto or on any other market. And that is all for today. If you are going to test the new Futures DCA bot, please share your opinions and results in the comment section and hit that like button, we will appreciate it. Thanks for watching and good trades to everyone.